This next section is a discussion around interest rates and the cost of money. Interest rates are essentially a proxy or a indication of how risky things are. So we're going to first talk about how they're calculated, and then we'll dive into some of the other information. So yield, which is essentially what the interest rate will give you, is calculated as the dollar return over the beginning value, or the dollar income plus capital gains over beginning value. And capital gains are the increase in value from a stock. So if you think about a typical stock, a stock will have increases in price or decreases in price, plus it should pay dividends. And dividends are payments that are made periodically, usually quarterly, to shareholders because it's a distribution of profits. And we'll talk more about dividends throughout the course. But when you think about yield on an investment, realized return, is going to be the dollar income, which is the dividend income, plus the capital gains. So that's the ending value minus the beginning value. How much money you made by holding the stock. That's called a capital gain over the beginning value. So there's a few things that impact the cost of money or the required the interest rate. The first one is production opportunity. So what competition is there for those investment dollars? How many opportunities are there for people to invest their money? If there's very few, then essentially the cost becomes lower because it's traditional supply and demand, and we're going to take a look at the supply and demand curve. If there's a lot of opportunities out there, then you may need to pay higher required return to attract the investment. Time preferences for consumption. So do people have a preference for shorter investments or longer investments? The risk, and risk is the term of art in finance, and it's essentially variation of return around the expected return. So what's the standard deviation of return? And then inflation, how much our price is going to go up over time. And these all get factored into determining what the required rate of return is. So interest rates are a function of supply and demand, and you'll get more of this in your economics courses, and you'll also get more of this in money and banking. But essentially, interest rates are driven by the demand and supply of dollars. So in this particular case, if there's interest rates are at 5 and you've got a low risk security, the supply of that security is this green line. At 5, there's a market clearing demand that could absorb this many dollars. If you increase the interest rate to 6, you'll have an increase in the number of dollars that are attracted to that investment. And so again, a lot of times a company may be solving for dollars. There's a supply curve, and they're trying to meet a demand. They're trying to identify the demand curve, which will then drive them over to what the required return is. This is a high interest rate example or a high risk security. You can see that the required rate of return is higher. So the supply curve is shifted up and to the left, and the demand curve then intersects at a different point. Then for essentially the same amount of dollars as you'd be getting 5% here, you may be getting 9% on these high-risk securities. This is a look at interest rates over time. So from 1995, which was when we were coming out of a recession, and it was kind of a boom time. Recession went from about 2001 to 1991 to 1993. So you had a relative boom time, and then of course you have the 2008 financial crisis, which occurred here, and then you had the 2000 recession, which occurred right here. That was the internet bust was here. This blue area is the 2008 financial crisis, and then of course you've had things going off into the future. So for short-term interest rates, you can see that they're far more volatile. That's the brown line. And so short-term interest rates, you can see here's a little bit of a leading indicator. So you can take a look and see that interest rates tend to rise immediately before a recession. So eventually at some point and you see the same pattern here before the 2008 financial crisis. So once you start seeing a run up in interest rates, you then likely will begin to see recessionary pressures. You can also see that over the last 20 years or so, the general trend has been down. So long-term and short-term interest rates have trended down over time. And the Fed funds rate, or the prime rate, is also, while that stayed relatively steady, it also is impacted significantly by by recessions, which are these blue lines. So when we talk about interest rates, there's two components to interest rates, and this is an important concept for finance. So you've got a risk-free rate, which means all things being equal, if you know that things are going to get repaid to you, you're going to still demand a risk-free rate because money today is worth more than money tomorrow. So this is going to be compensating you for things like inflation risk. And then you've got a premium for risk, which is the longer you go, the higher the premium. And this is essentially, you could think about it as a chance you don't get paid back. So this means risk-free. You're going to get paid back, but you still need to get a minimum rate of return to compensate you for inflation and not having the money available to you. And then you've got a premium for risk, which is essentially the compensation for the fact that you might not get repaid. And the higher the risk, the higher the required return. And that's just a common theme in finance. It's a common theme in pretty much anything in asset management. And if you just remember, the higher the return, the higher the risk. The higher the risk, the higher the required rate of return. When you see something that looks like it's too good to be true, it probably is. If the return is really high, then you probably have a fair bit of risk associated with it. Here's the determinants of market interest rates. You've got the rate of return is equal to the risk-free rate plus a risk premium. And risk premium, we're going to start reducing this down to some other functions. But risk-free rate is essentially the quoted risk-free rate, which, depending on the period of time, is going to be normally used. A U.S. Treasury note or bond will generally be used as a proxy for the risk-free rate. And then you've got the risk premium. Now, the risk premium is broken into three different parts, and those three different parts are compensated for differently, but added together, they come up with a total risk premium. So the risk premium, the three parts are the default risk premium, which is a chance you don't get paid back. The liquidity risk premium, which is the ability or inability to be able to utilize those assets while they're tied up in the investment. And then the maturity risk premium, which is the probability that you're going to be able to reinvest those funds once you get to the end of the investment time horizon for this particular investment. So you've got those three components. They get added together to come up with a risk premium. You've got a concept of real versus nominal rate. So the nominal rate is essentially the rate that's posted, and that's R. When you see R star, that's a real risk-free rate of return, which does not include inflation, so it backs inflation out. And R sub RF is the nominal risk-free rate, which includes the inflation premium. That is equal to the average inflation rate expected during the life of the investment. So for the nominal risk-free rate, you're going to have the real risk-free rate plus the inflation premium. And for the nominal rate of return, you're going to have the real risk-free rate plus the risk premium. And that's what those two elements are at the bottom. So again, you've got essentially the nominal rate is going to include inflation plus a risk premium. The risk-free rate is going to include the real risk-free rate of return plus an inflation premium. And here's the premiums added to the real risk-free rate for different types of debt. You've got short-term treasuries only has inflation premium for short-term inflation. Long-term treasuries have the inflation premium for long-term inflation plus the maturity risk premium, because there's a period of time and it's that you've got a risk that you're not going to be able to reinvest those dollars. Short-term corporates have the short-term inflation premium plus default risk premium. So because they're corporates, they might not get paid back Plus, you've got a liquidity premium because there may not be a secondary market associated with those that you may be able to transact. And long-term corporates, you've got inflation premium, you've got default risk premium, you've got maturity risk premium, and you've got liquidity premium. So when you think about how the yield curve should look, you would probably expect you would be getting the lowest amount of return on short-term treasuries and the highest amount of return overall on long-term corporates, because long-term corporates have to compensate you for these four elements of risk, where short-term treasuries only compensate you for inflation premium for short-term inflation. So the term structure of interest rates, and there's kind of rules and then there's exceptions. The rules generally are that as you hold an investment over time, the longer you have to hold the investment, or the longer the maturity is, the higher the required rate of return, because you add in, as you can see here, inflation premium for long-term inflation plus maturity risk premium. So maturity risk premium gets added in for each one of these long-term. So you should be compensated for that on top of the inflation rate. So the term structure is a relationship between interest rates and maturity. So what does the interest rate look like relative to how long or what the maturity is on a particular bond? And those can be graphed out, and the graph is called a yield curve. So here's a yield curve example, and you can see U.S. Treasury bond interest rates on different dates. So interest rates in November 2006, you can see that actually you had a relatively high 1 month interest rate, and the yield curve was inverted, which means you had a higher yield early and then it went down. It kind of dipped and then kind of started going back up at 20 years. At 2007, so as you're getting closer to the 2008 financial crisis, you can see the yield curve was still inverted. And in June 2017, after we've come out of the recession and the economy is doing well, you can see the yield curve is upward sloping. So one of the leading indicators I had just kind of showed you on the slide a few slides ago, that there was a leading indicator where short-term interest rates tend to climb pretty heavily just prior to a recession. You can also see that just prior to a recession, the 2008 recession, that the yield curve inverted, which is another way of seeing that the long-term interest rates stay relatively steady, but short-term rates tend to be more volatile and climb. And these are those three yield curves. You've got a typical yield curve, which is upward sloping. Then you've got an inverted yield curve, which is downward sloping, and then a flat yield curve, which would be the red one here. So there's three explanations for why a yield curve gets shaped the way it is. There's the liquidity preference theory, the market segmentation theory, and an expectations theory. For liquidity preference theory, everything being equal, lenders prefer short-term securities to long-term securities because short-term securities are subject to less interest rate risk and thus are easily more bought and sold, which is also a liquidity premium. And so short-term interest rates should be lower than long-term interest rates, and the yield curve should slope upward. That's liquidity preference. For market segmentation, borrowers and lenders have preferred maturities. They may be short-term or long-term, depending on what they see in conditions of the market and when they need the money and how long they want to borrow. So the slope of the yield curve at any given time in market segmentation theory depends on the supply and demand for funds at basically every point along the yield curve. And so it could be upward sloping, downward sloping, or flat, depending on what the supply and demand of funds are at that particular point in time, at that particular yield that's offered. And an expectations theory is the shape of the yield curve depends on investors' expectations about future inflation rates. And if the inflation is expected to increase, short-term rates are lower than long-term rates. And that's, again, typical of a economy that's doing well. You tend to see a steady rate of inflation. If inflation is expected to decrease, short-term rates will be higher than long-term rates. So when inflation decreases, you tend to see a recession. Prices come down, asset prices come down. You think about the 2008 financial crisis, where home prices dropped by 40 to 50%. That's deflation, and that's where you'll see an inverted yield curve. So forecasting interest rates on the expectations theory, but the inflation premium is the expected inflation rate for each period divided by the number of periods, where inflation sub t is the inflation rate expected in period t. So if you're going out for 20 periods, you'd put the inflation rate that you expect over 20 periods, you'd come up with the average of that, and then that would be the inflation premium for that period. The yield on an N-year bond would be the rate of return, the 1-year interest rate in that particular year, in year t, which is calculated as the real risk-free rate plus the inflation premium in period t, so kind of going out in each period, plus the default risk premium, plus the liquidity premium, plus the maturity risk premium in each one of those years. That becomes R here. And then you add those together and divide by N to come up with the required yield. So here's an example. Following our investors' inflation expectations for the next 3 years, you've got a 1-year inflation rate of 2%, 4%, and 6% in year 1, 2, and 3. So the expected inflation rate from Jan 2 of year 1 to December 31 of the indicated year, 2%, 3%, 4%. So again, you've got the 2% for the first year is 2%. 2% plus 4% in the second year will give you 3% over the 2-year period. And 2% plus 4% plus 6% divided by 3 will give you 4% average inflation rate over the 3-year period. So if we suppose the real risk-free rate is 3%, we got 3%, which is a real risk-free rate, plus the inflation premium in each one of those periods. So for the first year holding period, the second year holding period, which is 1 plus 2, and the third year holding period, which is 1 plus 2 plus 3. So we go back to these numbers here. And you get the nominal rate for each type of bond would be 5% for a 1-year bond, 6% for a 2-year bond, and 7% for a 3-year bond. There's a few other areas that impact and influence interest rate levels. Federal Reserve policy. So the Federal Reserve is an independent government agency that essentially sets monetary policy, and both the supply of cash that's available, M1, M2, and you'll learn more about that in money and banking, as well as sets the Fed funds rate, which is the rate at which banks can borrow, and also reserve policy. So how much banks can loan relative to have to keep in cash on their balance sheet. So those all impact the supply of money and therefore can increase or decrease interest rates. Federal deficits. The higher a deficit, in theory, the higher interest rates need to be, because the federal government needs to borrow money. So they have a high demand for money. And so when you think about if demand is high and supply is steady, then price goes up. And again, basic economics, if you have a fixed supply and demand goes up, then interest rates, which is the cost of money, goes up. International business, a foreign trade balance. If there is a lot of money that's sitting overseas, so for instance, we buy a lot of things from China, and so we pay the Chinese in dollars, and so they've got excess dollars, and they've either got to send those dollars back to the United States and get yuan, or they've got to invest them in the United States. That may create a foreign trade balance or imbalance that will impact interest rates as there's surplus dollars that need to be invested. So you've got additional supply relative to the demand for dollars. And then business activity. If business activity is high, businesses tend to borrow more money. If there's a lot of demand on cash and supply is relatively flat, then interest rates will go up. So again, when the economy is doing really well, interest rates tend to rise. When the economy doesn't do well, interest rates tend to fall. And interest rate levels and stock prices, generally, the higher the rate of interest, the lower a firm's profits, because if a firm has borrowed money, they have to repay that debt. And if the debt has a higher interest rate, then that will lower a firm's profit. Interest rates affect the level of economic activity, and economic activity affects corporate profits. So like I just said, if interest rates are high, it's tougher to borrow money. It costs more to borrow money. That will tend to suppress corporate or suppress economic activity. And as a result, that will start to push things into recession and impact corporate profits. So what you're going to find in general is there's a Goldilocks sweet spot of interest rates that tend to be not too high and not too low, and the economy will grow. So you'll see if interest rates tend to run between 5% to 6% on the top side, 2 to 3% on the bottom side, the economy tends to grow at about 2 to 2.5% per year. If the interest rates tend to tick up much higher than that, it starts to impact the economy, and the economy starts to slow down. So if there's a higher demand on money and interest rates start to rise, the economy starts to slow down. That reduces demand on money, and it falls back into an equilibrium point. So the economics in theory works well in that as demand goes higher and higher and higher, and the economy starts to grow quickly, interest rates rise. The rising interest rates tend to dampen the economy and kind of force it back to an equilibrium point. And if the economy starts to slow and there's lower demand for money, interest rates tend to fall. And so then it becomes easier to buy houses, to borrow money, to invest in your business, to borrow money, to buy things. And so that will then stimulate the economy and cause the economy to rise, and then interest rates rise with it. And again, one of the fundamental concepts here in finance is the value of an asset, any asset, is the expected future cash flows associated with that asset. And so we'll dig into this a little bit more as we go through the course, but this is also kind of present value associated. So kind of going back to chapter 4, the value of an asset is equal to the sum of the expected future cash flows discounted at the required rate of return. And so you'll see that this looks very much like those present value calculations that we saw in chapter 4, which is why chapter 4 is so important. And we're going to take a little bit of time over the next few chapters to dig into how these get applied. But the important thing to understand right now is the value of an asset, of a financial asset, is driven by the present value of the expected future cash flows. I'll say it again. The value of a financial asset is equal to the present value of the expected future cash flows discounted at the required rate of return.